Welcome to the TradeHive weekly COT blended institutional positioning report. I'm Britton Brown with TradeHive, and this COT report is for the week ending March 10th, 2026. I'm going to give you a quick summary on both the NQ and the ES market, and then I'll go move over to the TradeHive blended ES NQ market, and we'll get into the risk regime index. NASDAQ. In the NASDAQ, we had open interest drop 13,465 contracts. That is a significant drop. In the S&Ps, even bigger, 64,013 contracts came off the table. This is a huge change in open interest, and we can see significant contraction in positioning on this. I'll let you guys go read the reports yourself for the nitty gritty, and I'll put the links below in the description. I'm going to move over to the screen so we can take a look at the charts. All right, at the top here, we see normalized participation. Participation declined meaningfully due to the ES open interest drop and the NQ drop. Last week's normalized participation sat at 0.98. This week's new normalized participation sits at 0.971. Now, as a trader or investor, you've got to keep in mind institutions are still net long overall. But this chart is showing us that the pace of capital deployment is what slowed down this week. So I'd also like to bring to your attention where this sits in relationship to prices. And I think this is pretty big. We now have prices challenging the October and November 2025 lows. At that point, ES was trading at 6,600 and the NQ was at 24,120. However, what you'll see is we are above the January 20th and 27th participation levels. Now, back on January 20th and 27th in the ES, it was trading around 6,850 to 6,900, basically a 50-point range. And the NQ had a 1,000-point range from 25,100 to 26,100. So a couple things worth pointing out here. When we see participation low, we see the market basically running out of gas. Nobody wants to play the game, right? So we saw this number near the top. And interestingly enough, we're seeing this number again at these levels. With the prices down at the levels of last October and November of 2025, we can say that the premium's totally getting sucked out of the market due to all the risk that's in play and the lack of interest in putting money to work. Another important read here is leverage funds have begun increasing defensive positions while dealer activity suggests hedging flows are expanding. Next, we'll move down this graph here. We're looking at the stacked weekly net flow. This is where we break down the open interest and combine the two markets together. Now, we can clearly see asset managers in both markets combined are acting as the biggest participants this week, but not as aggressive as they were last week. Now, when we look at the leverage funds and the dealers, they were both dragged into the market, clearly stepping up their participation from last week's activity. Now, let's move down another section here. That's what we call the updated TradeHive big money pressure. And this is where things get really interesting. The previous week we sat at 0.212. This week the new estimate sits at 0.195. Obviously a significant decline in this gauge with the big money pressure. However, we still remain above the bullish threshold of 0.15. So what's my read here? For now, the regime is cooling but not yet reversing. A break below 0.15 to that 0.00 really neutralizes the whole bull market we've been in, and we're clearly still trying to desperately hold together. Finally, on the bottom here, let's cover the TradeHive Risk Regime Index. The previous week we were at 60. Now the read sits at 58. All right, that classifies this as a neutral risk-on market environment, and we can clearly see the trend here. Right, the trend is heading down. The regime is gradually cooling from late risk on toward neutral conditions. And obviously, we've got a lot of things going on economically and with the war that's going on over in Iran. So let's wrap this up for you so you can prepare for the upcoming week. I'm going to flip out of here. And just so you know, I will have those screens, that image available for you on the website tomorrow when I do the institutional framework. But in the meantime, in a nutshell, across both these indexes, we see participations contracting, institutions are reducing their long exposure, hedge funds are covering shorts. And this combination typically signals more of a risk moderation rather than a full risk off shift. Now for the warning. Yes, alarms are going off right now. This market is more fragile than it actually appears. We have short cycles in the NASDAQ and the Dow, which both have already rolled over from the February peaks. Intermediate cycles are weakening as industrial participation declines. Meanwhile, the broader S&P cycle suggests the possibility of a macro liquidity downswing that should develop around the second quarter of this year. And here's why the alarms are going off. When multiple cycles turn lower simultaneously, and that's what's going on, this often transitions into volatile consolidation environments rather than immediate crashes. Needless to say, the bull run is severely under pressure. Now let's dive into the trade execution takeaway. Obviously, the environment is still currently supported structurally. We're hanging on by a thread. We clearly see participation declining and momentum is fading. Now, when it comes to trading this environment, here's what you really need to know. You should expect more rotations in this environment. You're probably going to see fewer sustained trends and a higher probability of two-sided trade. I hope that helps you. This wraps up this report. Thanks for watching. If you want more free market information, you can check out my website at TradeHiveCommunity.com. You really won't believe what I provide traders like yourself for free. I do this to help you succeed in this business here. So until next time, I'll see you then. You guys, good luck in trading.